good. It's not like one or two stocks are doing a massive move. It's all small incremental positive gain that's adding up. Tata Motors, Tata Steel, Geo Finance, Reliance itself 0.7% higher. So these are the early movers. Eternal and Titan, two names from the discretionary consumption pack, looking very, very good. They're in leadership position on the Nifty. Not too many stocks on the downside, actually. Adani Enterprises about 0.5% lower. Adani Ports, 0.5% lower. Remember, there were the articles in the Wall Street Journal talking about some fresh challenges for the group in the US, something that the Adani Group has denied last evening itself. But those stocks have a tinge of red on them. Other than that, look at the banks, because the Bank Nifty is underperforming the Nifty right now. ICICI Bank, Axis Bank, slightly lower, down about 0.3%. But Nigel, it's not bad. 80 points up on the Nifty.
Well, that's right, Surbhi. Let's pull up a few stocks, though. Mphasis, they have clarified with regard to that news-based report on FedEx. They say that the company continues to be a service provider in FedEx ecosystem. The street is still a little bit nervous on this piece of news. And remember, it's PE-owned. So there's some speculation that maybe, in fact, that could be some kind of change of hands in the future. For the time being, the clarification is taken positively, and that's why that stock is up 1.5%. Transrail, they have bagged an order worth 530 crores across domestic and international geographies. That explains why that's one of the top gainers today. That's up close to around 5%. So big move out there. Niva Bupa, they have managed to get that block trade out of the way yesterday. We had a whole host of very, very good and solid buyers. So the street has taken that positively. It's up 2.5% or thereabouts. Two large trades, one flashing for you on the screen, Zinca. Sources say that Quick Routes International will sell close to a 9% stake by the block deal. That was at a big discount of close to around, I think, 8%. But the deal has got done at around 423. Is that indicating good demand? Well, we'll get in Nimesh to tell us a little bit more about that. But it's happened at around 423 or so. That's one stock. Aptus Value, that's the other one. Promoter was likely to sell close to around 9% stake in the company at a big discount as well. So Aptus is another one that's down close to around 8.5%. As we do that market check in the first 2 minutes itself, that big bounce has got sold into. The Nifty has now moved into the red. You'll have to say it's par for the course, because we have seen the markets in this broad band. Dips are getting bought into, bounces are getting sold into. What else is moving around? Yes Bank, that's down close to around 6.5% in today's trading session. The Anil Ambani Group stocks, that's Reliance Palm and Reliance Infra, they have had a splendid run in the last 4 to 5 trading sessions with massive delivery-based buying. Both of them have opened up with a cut of from 2 to around 3%. Interesting to see whether or not this dip gets bought into. So we'll keep an eye out on that one. And the new listing, Aegis Vopak, as Surbhi said, it actually opened up down yesterday close to around 5%. But it seems, going by the analyst feedback, the street is looking at the FY27 numbers, and they believe that the numbers will be very, very good. So on a trailing basis, the valuations were expensive, but part of the street is very, very bullish on the prospects going ahead. That's why that one is up and about. Surbhi.
Okay, absolutely. So looking okay, but on the Nifty, must keep in mind that the early pop has been sold into. So there is some caution in the market. And from what was a 100-point up move, now we're looking at a 10-point cut. So a little quiet. And even the mid-cap index, for what it's worth, when it's at the index level, it's given up the initial opening highs. We'll keep tracking the markets, of course. Let's get to our next guest then. Manish Sonthalia, Chief Investment Officer at MK Investment Managers, is our market master on the show today. Great to be with you. Good to have you on the show as always, Manish. Very interesting times for the market. I mean, we keep hearing a narrative building that earnings will eventually improve, rate cuts are coming, local macros are looking very, very good. But the market's still nervous, kind of sitting at the edge around this zone of 24,500 to 25,000. What do you make of things now that Q4 earnings have wrapped up?
So, Surbhi, good morning. I think earnings has not disappointed at all. Both the large caps, mid caps, small caps, all have come in better than estimates. And broadly, around 3,000 odd companies reported something like 15% growth in PAT, which is much better than what was built into when we started the earnings season. So that's not too much of a problem. I think the problem is to do with, the nature of the market these days. I mean, when you have a whole lot of negative news, the market tends to bottom. When you have a whole lot of positive news, the market tends to top out. So in the near term, I think it's just to do with this tariff thing, 9th of July. Till that point in time, I would believe that it's difficult to take out 25,000, 25,500 on the upside. Just because every bit of positive news has got priced in. And at the margin, you have seen the primary issuances, the QIPs, the press issues, they have started to pick up again massively. That was one of the main reasons why the markets actually tanked. You had a whole lot of primary issues get bunched up last year. So that's somewhat of a negative issue as far as the direction of the market is concerned. But everything else is on the positive side. I think market will bide its own time and maybe look forward to after the second half. Towards the second half of this year when you have all the monsoon and you have the rate cards, all of that got priced into.
All right. Hi, Manish. Good morning. Good to see you. Well, the number of large trades just continue, and Nimish will be joining in shortly to tell us. There are a couple of more that hit the screen. Yes Bank, the reason that it's down is because the P is likely to be a seller in today's large trade. And I think Ola Electric as well, there's a large seller out there. So these large trades just continue. Manish, what are you making of this fresh supply? The equity mutual fund industry, the domestic industry was sitting on ample amount of cash. Looks like a large proportion of it is getting deployed because in the month of May itself, promoters, that's the biggest risk, one would like to say. Share prices move up, markets get a little, buoyant, and they come in there and they cash out. Some would say rightfully so. Do you think it's a concern, or do you think taking some money off the table is okay? Your view?
So that does take out liquidity from the secondary market. If you have a whole lot of bunching up of issues, and we had a hiatus in the first 3 months of this calendar year when the markets were soft, and just that markets have started to pick up. You have a whole lot of issuances come through, and that do tend to take out liquidity from the secondary markets, and that's a big risk for the markets per se. And going by the number of issues that you still have for the whole of this financial year, I mean, it just remains a very big overhang. We just got to remember what happened in the last financial year. And if you don't have any solution to this, then obviously you'll have a problem in the secondary market.
While we wait for Nimesh to join us, because there are some, 4 or 5 blocks, he's been tracking each and every one of them, and the Yes and the Ola blocks have happened. While we wait for Nimesh to join in, on the lenders, Manish, we're at an interesting juncture. Yes is going through a metamorphosis, right, with the Japanese perhaps checking in. And then there is IndusInd Bank. The stock is halved. Everyone's waiting for a management transition. But every now and then you have these new shockers that keep coming in, that there was fraud, that this was not just a simple error, How are you looking at these two, lenders, mid-sized lenders, and IndusInd is, of course, a larger one, and the transition that they're going through? Manish?
Yeah, so of course, stock-specific actions will remain in the entire lending space, and both of these names which you alluded to are interesting names. Both of them look very good on a valuation front, and I think the Yes Bank issue seems to be lesser of a problem and can be a very big game changer now that you have a change in the management. IndusInd Bank, management issues need to be figured out, and then only valuations are absolutely fine. But we got to just figure out whether the entire thing has got cleaned up, and what is the new leadership going to do after they take over. So that's how I would look at it. But on an overall basis, not so too positive as far as the fourth quarter earnings season was concerned for the banks. High single-digit sort of numbers that came through. Valuations are perfectly fine, and now you will have a rate cut. So even there, you don't have too much of a margin expansion scope. You will be hurt on the margin side because everything will be a pass-through this time around.
All right. But you'll be positive on prospects of both these two banks, right? IndusInd and Yes Bank.
Yeah, they need to be kept on the radar. I mean, get figured out into our universe, and we'll figure it out whether they are worthwhile buying. But both of them look interesting.
All right, look interesting. Not stocks for the faint-hearted, but as you're saying, you believe there's good reason to find it interesting. But Manish, I wanted to ask you about the other one that's not for the faint-hearted. Vodafone Idea, it seems time is running out for them. And any kind of hope, on a day-to-day basis, the news flow is not really supporting it. The analyst community, some part of it believes that we'll have a 3-player market. What is your take? What's the way out for them?
Oh, the latest news about AGR dues not getting a waiver from the government. How will they get the funds? That's the main issue. Because the Supreme Court has denied them that exemption. You now also have the government not relenting. So in spite of the fact that we should be having a three-player market, what is the financial viability of this company? That remains a big, big question mark. I mean, unless and until you have somebody take over this sort of an entity with the liabilities that would come through, I mean, as a going concern, I don't know how they are going to survive. Just unable to figure out.
So you'll just stay away from that one?
Absolutely.
Okay, all right. Stay away from Vodafone Idea. Got that.
But just a quick word. Otherwise, Manish, Bharti, I mean, do you like the telecom space otherwise? Is that something that you have a favorable view on?
Yeah. So, Bharti is one of the names that we have in our portfolio. Even Reliance is there in our portfolio. So, I think both of them would be a play on the ARPU increase that's likely to happen over the coming years. And valuations are not very prohibitively expensive. Satellite telephony is around the corner, and all of these guys, both Bharti, Reliance, have a play in the satellite telephony as well. So I think it's a play on the ARPU game, and yeah, it looks interesting, both of them.
Okay, so otherwise you like the space and you like the leaders there, but cautious on obviously VI. Got that point. Manisha, stay on. We have more questions for you, but we were just discussing the blocks, right? The Yes block happened, the Ola block happened. So let's get our block man on with us in the morning, because he was alerting us about a lot of these stocks earlier on itself. And Nimesh, I mean, block season galore. Just recap the numbers for us, because so many hard to keep up with.
Well, Sir, so I was expecting 5 large blocks. 4 are done so far. 1 is still pending, but I'll start with Yes Bank, biggest F&O loser today. Remember, the stock rallied 8% yesterday, and today it's down 6%, 7% on the back of the large block. So 3% equity got changed hands at a discount, and hence the stock is under pressure. My sense is one of the large private equity investor was a seller in today's block deal. If you look at the scheduling pattern, there are 2 large private equity investors. Carlyle owns close to 6.8%, and Advent owns nearly 10%. One of the large PE was a seller in today's block deal. My sense is Carlyle has sold half of its stake. In fact, the sense I picked up was maybe there could be a clean out from Carlyle, which is 6.8% stake. So need to see whether there are more blocks, but in the morning block, 3% equity has changed hands at a lower price, hence that stock is under pressure today. The second stock is Ola, which is also under pressure on the back of a large block. Even in Ola, close to a little over 3% equity has got changed hands at a discount. And in Ola, my sense is that Hyundai, either directly Hyundai or Kia, they were the sellers in today's block deal. Hyundai owns little over 2.5%, and I guess there is some holding via Kia as well. So, but as far as Ola is concerned, the feedback is that most likely Hyundai and the group entity has sold a stake in Ola Electric today. So these were the 2 large blocks. Apart from that, Aptus, we all knew that there was a book launch, so there was a large block expected. Vesibis has sold clearly 9.5% stake in Aptus. And also there was a big block in Zinca as well, where one of the strategic investors sold out. But 2 blocks which are important. One is Ola, where Hyundai is a likely seller. And in Yes Bank, my sense is private equity investor was a likely seller.
So that's 4 done. And Nimesh, you're saying there's 1 more expected today, right?
Well, let's wait for the chatter.
Okay. All right. Oh, right. Absolutely. So we'll, connect back with you towards the second half of the day. Thank you so much for that. So that's the lowdown on the 4 blocks that have already happened. Manish, it's incredible, right? I mean, you imagine the kind of liquidity that the market is able to provide to give exits, all kind of exits, to PEs, to, promoters, etc. Remarkable, really, how far we've come. On Ola, slightly broader question. I mean, the trajectory of this particular company in the market has just completely gone haywire, right? Just your thoughts on the EV space, if there's any other way you'll play it. And I'm broadening it even further. I think 5th of June is World Environment Day. So if you talk about a sustainable play, whether it's EV, renewables, solar, etc., give us 1 or 2 stocks which look good.
So, with bated breath, I'd be watching out for the launch of RE electric vehicle, which is Royal Enfield's electric vehicle. They're calling it the Flying Flea. And it can be a game changer, or it could be a very bad move by the company, because you won't have the thump, for which Eicher Motors is known for, and has really is now clocking close to 1 million bytes every year. And that needs to be watched out very, very carefully. So, that is one name in the EV space. It can be a game changer. I'm watching that with bated breath. We have this stock in our portfolio, very decently valued, very decent numbers, cash flows, etc. So, I mean, this is one name. Except for that, in the electric vehicle space, you have a whole lot of valuation issues, volume issues, even the, the solar and the wind, the valuations are just out of whack. So, would stay away from the narrative around EV to a very large extent, but just that one name that we have in our portfolio, and that can be a big move.
All right. In the past, I recall your bullishness on Royal Enfield. The Flying Flea is going to be launched, I believe, in the first quarter of next calendar year. I've started my recurring deposit. Maybe, in fact, if it's good enough, we'll take a punt because every 6-7 years, normally I like to pick up a new motorbike. So I'll have that.
It's going to happen after increment season. So, makes it easy.
I'll just say that I'm keeping some money ready. Very quickly, Manish, before we let you go, I always make note of our guests who talk about stocks. And the last time around, I think you spoke about Star Health. And the stock did very, very well from there. And I think it's up 20-25% from the time we last spoke. Continue to remain positive on this name. And if you want, you're feeling, generous enough, give us another name.
No, I think, not too many changes after the earnings season this far. But, continuing on Star, I think when you have all the negatives priced in and things are likely to get better at the margin, of course, there will be naysayers who will be saying, no, the loss ratio is not going to be between 65% or thereabouts. It's going to continue at 80% or 79%. Then you create an opportunity, and valuation that 20 or less than 20 prices to earning multiples and a huge runaway for growth in the health insurance space. I mean, looks like a sitter for me. So no new name just yet. And Star Health remains a good bet for me.
Okay, Manish, what a nice, lovely conversation. It's always great talking to you. And this time, I think we managed to get very, very specific on lots of theme sectors as well. So thank you very much. And of course, the disclosures, the usual disclosures apply for all the stocks discussed. Thanks for joining in. You have a great day. For the time being, it's time to get back to some of the corporate conversations. We're going to be talking to Blue Star very soon. But before that, I just want to point out that the markets turned for the worst. We started positive, 100-point pop. That got sold into, and now it's an 80-point dip, almost a 90-point dip on the Nifty. So it's a downward trend line for now. Let's see if we get the buyers in at some point. But back to the corporate conversation. Then Blue Star is the company on the radar. We've seen a pretty steady quarter come through. Q4 was steady for Blue Star, at least at the top line front. Small issues on the margin, which we'll discuss. But the question is, what's the demand picture looking like? We have with us Mr. Rabi Thyagarajan, MD at Blue Star, joining in. Mr. Thyagarajan, good morning, sir. Always good to have you on. And I remember, when we spoke, I think this was in early April. That time, because of these unseasonal rains that were coming in, the April demand was not that great for air conditioners. I wonder how May has May made up for it? Tell us, how has the year started off? What's your assessment so far?
Shrubi, good morning. It's a pleasure interacting with you. Yes, we had spoken in March. I had said that industry is looking forward to a 25% growth over last summer season. Industry indeed had prepared, and we had prepared for a 30% growth. April was bad with rains across many places, but most importantly, in March last week, as you may recollect, anticipating compressor shortage, the trade started stocking up more. So the inventory opening levels were very high in April. But the fact of the matter is there were rains across the country, and we managed to grow only by around 5% in April. May was bad. May, in fact, monsoon set in most part of the country. And therefore, this summer is a bad summer, like it was in 2023. This is going to be a tough period to navigate through and wait for the festival season. That's where we are.
All right. Hi, sir. Good morning. Nigel on this side. Good to see you, Ben. So it's a rough start to the year. If you could help us out with a couple of numbers. For last year, I think the RSC volumes clocked around 1.53 million, and you did very well because your market share as well moved to around 14% or thereabouts. For this year, what kind of a volume number should we be looking at given this soft start? The good news, though, is commercial refrigerators that had a rough FY25. That started off FY26 on a positive note with a good bump up out there, and that contributes a good amount to the UCP business. What is the number and what kind of growth should we look at in this vertical? Please go ahead, sir.
Good morning, Nigel. You're absolutely right. It was a significant year that Blue Star crossing the magic figure of 1.5 million and industry volume crossing 15 million. And whenever the summer season had failed, the rest of the season does well. And I anticipate at least 10 to 15% growth on a full year basis. In other words, FY26, one should anticipate between 10 to 15% growth. So that 1.5 million, it has got a potential to grow to 16 million. In our case, it will be 1.6 million. I think that it should take place if I plot all the years in which summer season had been bad. In a manner of speaking, that we often talk about cricket, it is like rain, the Duckworth-Lewis method. So you work hard the rest of the period in order to make it up. So it has happened in the past. I don't see any particular reason why it should not take place. And we will continue to look at improving our market share. Our goal is to reach a market share of 15% by FY27, and we will be on that.
So just reiterating the numbers, you're saying 10 to 15% full year top line growth, right? You're expecting 3, 4 and 5, quarter 2, 3 and 4 to make up for it, right?
It picks up generally in end of Q2 and Q3 as the festival season begins. So I have plotted all the years in which summer season had been bad. So there is an indication that it will make up over the period. That's what one should anticipate.
Okay, all right. And just to reiterate, 1.53 is what you did last year. So a 10-15% growth will take you to around 1.7 million approximately on the RAC volume.
1.65 is the one we will look at
1.65, got it.
Number. And the commercial refrigeration you talked about, it was a bad year last year with many regulatory changes, etc. So therefore, it is doing well in whichever is the category, whether it is a cold store or whether it is a chest freezer, deep freezer, driven by the processed food consumption, pharmaceutical. These are the segments which are driving growth.
So I just want to clarify this 10 to 15% growth guidance. This is only for the RAC business, or are you talking about overall top line? If you could just share the overall top line estimate as well that you have for the year.
I am talking about first the room air conditioner business.
Okay.
Summer season should have been 25 to 30% growth. It has not happened. But whenever summer season fails, it will be made up in the rest of the period. And I think 10 to 15% growth is possible. That is the anticipation. We will work towards that. Second is commercial refrigeration. It should grow between 25 to 30% because the base is very small and the demand continues to be good. And last year was bad. On that base, that growth should not be a problem. We are carrying forward order book of over 6,000 crores, as you may be aware, in the electromechanical project segment, and that should happen. Fortunately, Blue Star is not dependent on B2C alone. We have significant part of our revenue coming from B2B businesses. Commercial air conditioning business, which is driven by manufacturing, data center, shop, showroom, boutiques, that continues to grow. That should grow between 15 to 20%. So it is too early to predict overall Blue Star revenue growth, what it should be. I am of the view it will be definitely in double-digit growth. Yeah, one month or 2 months of rain will not create a major difference for us.
Okay, got that. So overall top line growth should definitely be in double digits. The AC business should grow 10 to 15%. Got that point. Sir, just a quick update on margins as well. Because in the fourth quarter, there was some pressure that came in on the blended EBITDA margin for the company. Though individually speaking, the RAC segment did well. There your margins were over 8% as well. So just give us some sense on both the EMP side, RAC, what's the margin profile and anticipation for the full year?
So I continue to maintain segment one, that is electromechanical projects and package air conditioners. It should be in the region of around 7.5%. In the unitary cooling products, which includes room air conditioners and commercial refrigeration, we have been maintaining full year basis. It should be 8 to 8.5%. In a summer impacted year, that will come under pressure. Something has to be made up in the last quarter. See, what happens is your marketing spends, you end up incurring something like IPL, etc. And it's not delivering because of the seasonal rains, unseasonal rains. So therefore, we will have pressure to deliver that 8 to 8.5. We are not changing that outlook. We will keep watching this. If it has to be corrected, I will let you know by H2 beginning. That's when we will have a clear picture.
Okay.
It is possible to deliver 8 to 8.5.
That 8 to 8.5 on the AC business.
Unitary cooling products.
Unitary cooling products business. Got that.
Okay. All right, sir. Since it's been a rough start to the year, what about pricing? How does it move? Besides the shareholders, a lot of clientele as well will be watching you. They want to know whether Mr. Titagarh is going to go and push through another price hike. Possible or not?
No, April first week we had increased the prices, and our policy remains the same. If there is an input cost increase, pass it on. If it is coming down, reduce the prices. See,
So now it's coming down then, sir. So I see some input costs have cooled off a little bit. Will you cut prices a little bit because you took a price hike in January as well as April, right?
That's right, February as well as April. I think a review will take place beginning of the festival season, just before Onam. That will be in August. See, inventory is no longer an issue in the country for the simple reason local manufacturing is taking place, and we shouldn't have any problem there. Some minor adjustments will have to be done to enable the dealers to liquidate their stocks, which normally we all do. The price reduction or increase will depend on the outlook for input material costs and the exchange rates, which we will do in the month of August.
Okay. All right, sir. Thank you very much for giving us a complete perspective on how the business is playing out. So even though the start has been weak and these rains have kind of dampened the early summer demand, you're expecting the rest of the year to make up for it. Good to know that. Thank you very much for joining in. You have a great rest of the day. All right. That's the word coming in from Blue Star. We will take a very quick break on that note. Coming up on the other side, quick update with Mr. Umesh Chaudhary of Titagarh Rail Systems. Talk about the company's Q4 performance and the outlook. Welcome back. Let's just go back to the screens and see what the market's been up to. Still down about 70 odd points, but caps are fighting back as usual. There's some green on the mid-cap screen for sure. Let's pull up Swiggy. That's a stock in sharp focus. Right now on my screen, up about 2%. We've got Mangalam joining in with a quick update on this one. Mangalam.
Well, this morning there's a note that has come in from Morgan Stanley, and they've initiated coverage on Swiggy with an overweight rating and a target price of 405. This overweight, according to them, is premised on three things. One, improving execution in food delivery. Secondly, expanding quick commerce total addressable market and the aggressive investment that the company has made. And the third thing that they're saying is that the market is pricing in steep investments, but they're not yet giving any benefit on top line. And that's where they differ from the street, because they believe that it's a duopoly market, improved execution by Swiggy, and close margin gap versus Eternal, Zomato, that is for the food delivery business, is something that will do well for them. They've revised their quick commerce total addressable market estimates higher, close to $57 billion by 2030, and they assume that Swiggy will maintain its market share. What is it that they're expecting? They will say that the quick commerce business will be contribution margin break-even in the next 6 quarters, adjusted EBITDA break-even by second half FY29E. They've given a 25% discount to Swiggy's quick commerce business versus Blinkit, and about a 5% discount to Swiggy's food delivery business versus Zomato, and that's how they've come to the target price of 405. That explains why the stock's doing well.
Okay, all right, Mangalam, thanks a lot for that. Well, let's focus on another name then that came out with its set of numbers. That's Titagarh Rail. They saw weakish performance, margins under pressure as well. In both the segments, I think there was some kind of weakness. The point is that they have some kind of issue with regard to the wheel sets. To understand more, we have Mr. Umesh Chaudhary, who is the Vice Chairman and Managing Director at Titagarh Rail, who joins us on the show. Hi, sir. Good morning. Thanks a lot for joining in. Well, it's been a little bit rough because of the point that you've been mentioning. The wheel set availability has been an issue for the past quarter, and I think it'll plague some part of this quarter's performance as well. So could you tell us where we are at with resolving this issue, and by when do you see things return back to normalcy? From quarter 2 onwards?
Yeah, so good morning. Thank you for having me with you. So there are 2 ways of looking at this wheel set issue resolution. One is the long-term permanent resolution and one is the immediate resolution. The long-term permanent resolution is what we are expecting when our wheel plant, which is a joint venture with Ramakrishna Forging, comes into production next year. And that, wheel sets has been a perennial problem ever since we've been in this industry for the last 25, 27 years. Every couple of years, for 1 or 2 quarters, there is a problem that is faced from the wheel set supplies. And that's the reason why the government of India actually took up this wonderful initiative of making India truly self-reliant and setting up or encouraging setting up this wheel plant that we are doing so. So that is one. But on the short-term basis, there were some production challenges that Rail Wheel Factory was facing ever since, I think, if my memory serves me correct, since October or November. But now the production has, from this month, from June itself, from yesterday, it started streamlining. So from the month of June, we expect that the wheel set problem should be things of the past.
Okay, that's good news then, sir. Give us a few more details. How many coaches or, motors converters will you deliver in this fiscal year in comparison to last? If you could quantify it.
So absolutely. So we have 2 distinct lines of business. One is the freight rail system where we are doing the wagons. So last year we did the largest number of wagons that any Indian company has ever made in India. We produced about 9,500 wagons and delivered them. Of course, we could not achieve our target because of this wheel set problem, but nevertheless, it's a great milestone to have. And the second business that we have is the passenger rail system. There we have both metro, Vande Bharat, and propulsion. So coming to the propulsion that you were asking, the traction motor, this was the last year was the first year of our being in that business. And we did about 600 and odd traction motors, which is an average run rate of 50 traction motors a month. And this year we are targeting to ramp it up to about between 125 to 150 traction motors a month. And going forward, we'll ramp it up to about 200 traction motors a month. But that's only one part of the overall execution of the passenger rail system. The Pune Metro has gotten completed earlier. Now the Bangalore Metro is getting executed. And followed by that, the Gujarat Metro will start execution in end of Q2 or beginning of Q3. So, we've also started the production of the Vande Bharat coach last month. In April, we made the first cutting of the car body material for the Vande Bharat train. So overall, the passenger rail segment is going to be the one that is really going to see the big quantum jump in growth, both in FY26 and then followed by in FY27.
Absolutely. And those metro orders are continuing to roll in. Apparently, that's what the indications are. I think you're also L1 in the Mumbai Metro, Line 6 tender. So I think all eyes on that one as well. So just some numbers, sir, because there are multiple businesses. I have, questions divided into several parts. Since we are talking metro rail, the passenger rail system, let's talk about that. From the metro business, I mean, what is the increase in the order book, the execution of that order book? What's the quantum of business you're expecting in metro rail? And if you could just, shine a spotlight on the Mumbai order as well.
So as far as the Mumbai order is concerned, yes, we understand we are L1 along with NCC in line 6, but we would not like to comment on that because it will be speculative. We would only comment on it when we physically have the order in our hand. So that's been our policy. But as far as the overall metro segment is concerned, or the passenger train segment overall is concerned, I think it's an extremely buoyant market. We are seeing new projects being announced. Jaipur announced their expansion of metro. We've seen Gurgaon. We've seen, every month we've been seeing some project or the other, because urban mobility is something which is the need of the hour, and it's the most urgent need of the hour. On a lighter note, I saw the comment of Minister Nitin Gadkari that he can solve all the road problems of the world, but not the traffic problem of cities like Bangalore. And the only solution is a metro system, or an effective metro system. So coming to our capacity, we have just kind of done about maybe 2-3 cars a month on an average last year, which we are intending to ramp up substantially. We are wanting to ramp up to reach about 20 to 25 cars within Q4 of this month on a monthly run rate basis. And our ultimate targeted capacity, which is for both combined Metro and Vande Bharat, is about 800 to 850 cars a month. So that we are expecting to achieve by FY27 or FY28.
So with this expanded capacity, and a lot of that is going on stream by the end of this year itself, give us a sense, the metro business, what should be the revenue expansion we can expect?
As I said, it's going to be from 3 cars a month to 20-25 cars a month.
25 cars.
And then going to 27, 28, FY27 and FY28, we are looking at getting it up to about 60, 70 cars a month. So it's a huge leap that we are taking forward in this business segment.
No, absolutely. And now I'm going back to the wagon production, because you said a lot of these train set issues, the wheel set issues, that's getting sorted out. You had produced, I think, 2,455 wagons in the fourth quarter. Full year, you said you were close to, 9,500 wagons. So give us some sense of what will be the run rate, how much will you do this year as this wheel set problem gets sorted out?
So, there are 2 elements to that. One is the production capacity, which includes the supply chain of wheel sets, and the second is the order book. So, we are coming to the end of the order execution that we had received about 2.5 years ago. Of course, this will see us through to this financial year, to the end of this financial year, and we are expecting new orders to come in. And I also believe that this is something that the government of India would definitely continue to procure, because this is the only way the logistic cost reduction is possible. So if we are able to get adequate orders by way of the new tenders that we are expecting this year, which we are extremely hopeful of getting, but at the end of the day, it's tenders that have to be floated. We should be able to stabilize at 1,000 wagons per month on a very easy basis. I would also like to mention that, I had mentioned earlier in your shows about the backward integration. So we have been able to expand our foundry production to about 25,000 tons, which is again a record production, which is much higher than what we had done in the past. And our new line of the foundry will come into stream in Q2 of this financial year. This would actually make us self-sufficient also for the foundry for 1,000 wagons a month. So that will give us the complete...
Yeah, that's 12,000 wagons in a year compared to about 9,500 that you've done this year. Got it. I mean, some rough estimates there.
All right. So what would that mean in terms of numbers then? Revenue growth, give and take everything. The wagons, the cars that you're referring to, coaches, between that, various verticals. The street wants to know 2 numbers, and then I'll ask you the third one. First is, what kind of revenue growth can you deliver, and what kind of margin outlook for FY26 in comparison to FY25?
So you see, I'll answer your second question first. As far as margin is concerned, we've always maintained that on the freight side, we expect a margin of around 12%, 11, 12%, give or take percent here or there on quarter-to-quarter basis. But a blended basis, 11 to 12% is a margin that is sustainable in this business, and we expect to maintain with that. As far as the top line of the freight is concerned, at 12,000 wagons, each wagon sells for between 35 to 40 lakhs. So that's the revenue targets that we are looking at. As far as passenger coaches is concerned, this is a business where we had really very little revenue going in the past. So as far as the ramp up is concerned, when we talk about one passenger coach, it sells for about 10 crores. And Vande Bharat, our share of the pie, because we are in consortium with BHEL, is about 4 crores. So it is a quantum jump that we are looking at on the passenger side. On the margin of passenger as well, I would divide it into two segments. One is when we have been able to integrate our entire propulsion, then we are looking at about a 14-15% EBITDA. But till we have been able to do that, which is going to take about 2 to 3 years' time, we should look at about a similar 10 to 12% EBITDA on the passenger side as well.
All right. So, ballpark, I'm just looking at 12,000 wagons at around 35 lakhs. That should give you around 4,200 crores approximately.
Yeah,
and on the other side, you said around 4 crores. And what is the quantity?
4 crore is our share of the train, and 10 crore is our share of the metro coaches.
Okay, all right, 10 crore metro, got it. So ballpark, if I put the the numbers together, this year you ended up with close to around, I think, 4,000 crores, very, very approximately, 3,900 crores approximately.
That's right. Approximately that much, yeah.
So we're looking at a 25% revenue growth?
I would not be able to give any forward-looking numbers right now. I mean, I've given you the execution, and of course, execution capacity I've given you. In the case of metros, we have the orders for the freight. Also, we have the order for this year. And then the execution will, of course, drive it. But of course, if we talk about the capacity that we are creating, that the capacity that we are creating in the PRS is almost 7,000-8,000 crores of revenue in a year.
Okay, all right. What about operating cash flow, sir? That was negative for the past year. Will you align things, and see a positive operating cash flow number?
Yeah, we will definitely be able to do that. This was primarily because, we had organized all our inventory, but the wheel set was a dampener, and that's the reason why the operating cash flow got blocked. Unless we had the wheel set, we could not convert the WIP or the inventory into cash. But that's a short-term phenomena. We are not worried about it.
All right, sir. Lots of details there. Thank you very much for patiently answering all of our questions. Gives us a good sense of how you're set up for this year. Thank you for joining in. Well, that's Titagarh Rail, and the stock has been doing, well, not too much today, but it's recovering from the lows, at least for the time being. Back to the markets, and we have Mitesh with us. Mitesh, volatile morning. Market's still down about 80 points. So it was up, then it's down, directionless at the moment. What's the advice?
Morning again. I think the index still remains very strong. The good thing is that now we are getting close to the lower end of the range, which is around 24,500 or so. So I think maybe around those levels, if you get another 70-80 point kind of cut, you would look for some kind of reversal signals on the index and try to buy. On the stock side, I have a buy on SRF with a stop at about 29.30, targets of 30.50. I think that's a stock which looks like it's completed a correction and could move up. And the other stock is a sell on TCS with a stop at about levels of 34.65 and a target of around 33.70 can do that.
Okay. All right, Mitesh. Thank you very much for the calls there. So those are some trades to work with for the time being. Let's get back to the market. Q4 earnings season finally over, and it has been better than a lot of subdued expectations. So let's discuss this and more with Gautam Dugard of Motilal Oswal Financial Services. Gautam, always a pleasure to have you on the shows. I've got your note open in front of me. It says earnings review, fourth quarter FY25, beyond the benchmark, a surprise surge. So that's a pleasant headline to start with. But I must place on record here, because now that you've done the numbers, we ended FY25 with Nifty earnings growth of 1%, right? 1%. That's, I mean, we always knew it was a bad year, but that's still shocking. So 1% se to upar acha hi hoga. Definitely we're going to be much better this in FY26, right? But your thoughts on this earnings recovery that everyone's anticipating?
Yeah, good morning, Sobi. Thanks for having me here. So look, FY25 ended on a flattish note for Nifty as well as the broader markets. A 1% EPS growth basically is a 4 to 5% profit growth. There is obviously a free float related factor adjustment depending on which company has driven the earnings. But suffice to say that FY25 was a flat year. And this year has come after 4 massive years of 24% earnings CAGR between FY20 to 24, right, for the broader markets and close to 20% for Nifty. There were many factors, obviously, as we all know. We've seen that in the first 9 months. This quarter, the bigger news is not just Nifty, but beyond Nifty, which is why we wrote beyond benchmark. So, for example, if you look at the mid-cap coverage universe that we have of close to 90 stocks, the earnings growth is 19%, right? Large cap growth is 10%. My broader coverage universe of 300 stock, the earnings growth is 10%. And it's not led by one sector or two sectors. So there are 19 sectors which have delivered numbers which are either in line or better than expectations. Only 3 sectors have missed expectations. They are very small. Second, the breadth of the earnings has been fairly good. 74 to 75% of the coverage companies have delivered numbers which are either in line or better than expectations. This number usually is 64, 65%. So clearly, sequentially, we have seen better bottoms-up performance. Third, the upgrade to downgrade ratio has improved massively. The upgrade to downgrade was just 0.3x. This quarter it is 0.6x, right? While we have seen downgrades in FY26 for Nifty by close to 2.5%, but we are still expecting about 12 to 14% earnings growth next year. Now, obviously, the spread of the sectors will change, but this quarter has been fairly good. When we spoke at the time of preview, I would not have imagined that we will grow 10-11% this quarter. And that's why I highlighted that this is not led by one or two sectors. Multiple sectors have done well and beaten expectations.
Gautam,
so
just checking,
good momentum.
Gautam, just rechecking that number, 19% was the earnings growth of your mid-cap coverage universe in Q4, right?
Yes, so 89.
Yeah, that's a good number. So I was just double checking on that. Got it.
Yeah, so 81 companies we cover in the mid-cap domain as per SEBI classification. For those 89 companies, we were expecting a growth of 9.6%. The actual delivery is 19%. And even if you exclude commodities, the growth is close to 15% for mid-caps. However, the bad news is that small caps struggled. So small caps, we cover about 122 small caps. For those 122 small caps, the earnings growth, earnings decline was 16%. Entirely led by financials because there were a lot of MFI and some of the NBFC small cap companies which posted bad numbers. Excluding financials, also small cap numbers were flattish. So whichever way you slice or dice, small caps underperform, mid caps perform very well, and large caps perform in a very steady 10% kind of a growth fashion.
All right. Hi, Gautam. Good to hear your thoughts, and I was happy to read your note as well on Sunday night. Now, I want to ask you a couple of questions. You all are working with the 12% Nifty EPS growth for FY26. What's the downside risk to that? Because normally I see, even in the last year, a lot of brokerage firms, not just yours, started off with higher expectations, and gradually that graph came down, and we ended up with only 1%. And Surabhi sounding very optimistic. She's saying that this year, though, is going to be very good. What's the downside risk to that 12% earnings growth that we're working with?
So let me first speak for all the brokerages, because in FY25, it was the first year where we had to cut by such a big magnitude. And this was the first year where earnings got downgraded by double digits. FY21-22, we had upgraded estimates throughout the year. FY23 was very steady. We didn't cut, neither we upgraded. FY24, again, there was a 2 to 3% upgrade from where we began with. So, while it does give the impression that brokerages are always starting with a higher numbers and then they cut through the year, but the record is slightly different. 4 years, there was no number cut. FY25, therefore, was the first year in 5 years where numbers got cut by a big extent. As regards your question on what can go wrong and what can lead to downside in FY26, Nigel, see, we are living in a very volatile environment, especially globally. So commodities, obviously, while they do not have significant weightages in the indices, but their weightage in profit pool is massive. So, for example, if you look at Nifty 50 profits, in Nifty 50, commodities are roughly 20-25%, metals and oil and gas. And that's a number which keeps on changing every quarter depending on the underlying commodity prices. Plus, it also gets impacted by a lot of global factors. So that's a number where we usually don't have a very strong handle. We take it as it comes and mark to market it. Aside of that, I think 10 to 12% earnings growth doesn't look difficult. While the sectoral mix may change as we move forward, we might expect some sector to do well and something not to do well. It can interchange during the year. But 10 to 12% growth doesn't look that difficult to me at this stage if you're able to print a nominal GDP close to 9 to 10%. Right? Plus, you have income tax cuts, you have rate cuts which are happening. Capex has peaked up to March number was massive, 2.4 trillion. Come to think of it, that capex number of 2.4 trillion in March was our annual number in FY15. And whatever we've done in a quarter in 4Q FY25, the capex number was a full year number in FY20. So we've come a long way on capex. Obviously, this thing happens slowly. We tend to forget and appreciate the impact that it creates over a period of time. But I think capex should look slightly better as we move forward in FY26. So 10% is what you should move with or work with.
10 to 12%.
Yeah.
10 to 12% full year earnings growth FY26 for the Nifty.
Yeah. And then, of course, you have a hard work to do, which is to identify bottom-up ideas.
I was going to ask you to do that hard work. I mean, now tell us, which are the horses to bet on? Kaun se ghode jaldi bhagne wale hain, as they say, in this earnings race?
Yeah. So, Surbhi, look, we've had a very positive view on few of the sectors, which fortunately has turned up quite well. For example, the financials, where we timely made the switch from underweight to overweight back in October. That has worked exceedingly well. If you look at the returns this year, calendar year 25 YTD, first 5 months, the banking index is up close to 10 to 11%, and IT index is down 14%, which is where we had cut weight in January. Now, it's our thesis since last many years, and we had put out 2 big notes on this a couple of years back, that in any given year, banks and IT do not outperform together. The only exception was CY17. Otherwise, job is slightly easier if you are able to pick between the two. And this year, we made that choice of picking banks over IT. So far, it is turning out well. There is a 25% outperformance by banks over IT. And not that we do not like IT. IT also is reasonably priced now, especially the large caps. But our overwhelming preference is for financials. And within financials, it is non-banks and non-lending NBFCs. So capital markets, there is preponderance of capital market plays in our model portfolio. So we like BSE, we like Angel, which is our 40% in the last 2 months. We like HDFC, AMC, Nuvama. In NBFCs, we prefer Shriram. And of course, in banks, we have Kotak Bank, ICICI, and HDFC. So banking is a big pack for us right now. Second, we like consumer discretionary, which has been the overweight stance for the last 3-4 years now. And it seems that consumer discretionary results this quarter were far better than expectation across multiple subcategories: jewelry, apparel, even footwear to an extent, and then QSR. And then we like industrials, we like telecom, we like pharmaceuticals. And incrementally, we are finding auto slightly better position. Now, we've been underweight on auto for a year, but given the current risk reward, I think auto is looking attractive again. The expectations are very modest in auto, and valuations have corrected a fair bit there. So that is now looking like a stance that we might have to rethink.
Okay, interesting. Yeah, are we at some sort of an inflection point for the auto sector? Interesting thought to wind up the discussion on, and we'll probably dwell on that in the coming chats as well. Thank you very much, Gautam. Always a pleasure speaking with you. Thanks for joining us.
Thank you.
Thank you. We'll take a break on that note, come back on the other side, and of course, as always, get you a roundup of all the commodity market action with Manisha. Welcome back. So let's find out what's hot in the world of commodities. We have Manisha joining in with the latest. Manisha, good morning. Now tell us, what do you have your eye on?
Well, overnight, almost all commodities have done quite well, whether it was energy, base metals and precious metals. So I'm looking at precious metals right now because we've seen 2.5% of gain in gold prices overnight. That one is trading at a 1-month highs. And the silver prices gained up by 5%. We're trading at a 7-month highs as far as the silver prices go. So when you look at the report card that stands as right now, on a month-on-month basis, gold is up by 2%, but silver clearly outperforming in the very near term there. When you look at the YTD chart, then the gold prices have gained up by 28%, while silver has gained up by 18% there. So silver still has to do that catch-up in sense of longer-term period averages there. But as you can see, it has been a good going, a strong report card that you can see for gold and silver both. Well, various factors which seem to be supporting. One is the dollar index, which is now trading at near 3-year lows, and that has been supportive. The markets also are looking at the Russia-Ukraine conflict escalating yet again. It has been going on for 3 years, but these spikes, even as there's conversation of ceasefire, leads to more premium buying in case of gold and silver. Also slightly risk off because we've seen some of the regional equity markets not do so well. That money seems to be flowing into gold as well. And there are renewed trade uncertainty happening yet again between US and China. The legal battle over legality of the Trump's tariffs is yet another thing that the street is watching quite closely at this point in time. And then you have reaction to the weaker than expected economic numbers from Eurozone, from China and from US as well. It also is about US doubling tariffs on aluminum and steel to 50%. So the last couple of days actually have been looking at stronger buying for the gold and silver prices there. And the US budget deficit of 1.9 trillion for 2025 and 36 trillion plus above for overall is something that will lead to gold buying going forward. The markets also will watch out for Powell testimony and various other Fed officials which are slated to speak in this week. We also have the US non-farm payroll data, the ECB monetary policies. These will give you further directions in. But at this point in time, we are trading very close to $3,400 an ounce for gold and almost $35 an ounce when it comes to silver as well.
Okay, all right. So green gains coming in over there. Thanks for that, Manisha. We do have to take another quick break. Coming up on the other side, our special segment, it's the economy. Today, Lata will be in conversation with Claudio Eriogin and Rahul Bajoria on the US and Indian debt markets.
Welcome to It's the Economy. The dollar index has slid to a 6-week low overnight at 98.6 after President Trump threatened to raise tariffs on steel and aluminium to 50%. Now, US yields have been hugging that 4.5% mark for some time now, especially after the big, beautiful bill was passed by the US House. That bill threatens to raise the US deficit for the foreseeable future. The currency and yield markets actually all over the world have broken long-term patterns. Japanese yields now are ruling at the highest level since 2008, although, of course, today's auction received a little more bids. Yet most of ex-Japan Asia, including India, are in a rate-cutting cycle. To understand more about global yields and currencies, I have with me two experts, Claudio Irigoyen, the head of macro research, global research at BOFA, and Rahul Bajoria, again, head of global research at Bank of America. Thank you very much, gentlemen, for your time. Claudio, let me start with you. This yield market is giving us altogether new patterns. What do you think will be the impact of global flows as Japanese yields and US yields remain high?
Well, I think we are in the middle of two main themes that will drive US growth in particular, and will have implications for the rest of the world. The first one is obviously the evolution of trade negotiations that will impact many countries. As you know, we have the view that Trump administration wants to negotiate comprehensive country-specific packages involving trade, immigration, defense, and energy. By definition, those are negotiations that will differ from country to country. And tariffs are a tool that is expected to yield a lot of dividends. On the one hand, raising revenues, on the other hand, being a tool to negotiate better trade agreements, and also an incentive to bring back manufacturing jobs to the US. And the connection with the second theme is obviously the discussion of the fiscal bill in Congress in the US. And the reason why they are connected is because part of the discussion is how much tariff revenues you can collect, because that will determine the size of the fiscal deficit that will end up being the outcome of the negotiations in Congress in the US. I think the market is starting to pay more and more attention to that. We are seeing that in the way the long end of the yield curve is trading in the US. And as you mentioned, it's also important what's going on in Japan. Basically, we're in a situation in which fiscal policy has been very loose for many years in many countries, under the assumption that interest rates were going to remain low forever. Now we are in a different regime after the pandemic, and obviously the pressure on debt dynamics in many countries will be in crescendo, and we're going to see that in the way yields are going to remain trading in the near future.
Yeah, that's a big point. Most developed market governments, or at least two large ones, have been profligate with their fisc. But it's in contrast to the Asian or emerging markets, which were the old, spendthrifts, are now finding much more fiscal discipline than their own past. But Claudio, what will this mean to flow of funds into Indian bond markets? If the US bond yields are high, but the US currency is weaker, do you expect that we saw good flows into Indian bonds? Will that continue?
Well, I think what markets are trying to figure out is how to rebalance global portfolios now that they are not as in love with US assets. Before all this trade uncertainty started, global portfolios were massively overweight US assets, underweight emerging markets, and in particular Europe. And since then, we are observing a rebalancing towards more neutral positions. And that creates, to some extent, winners and losers. Markets are trying to figure out what are the more neutral countries in this trade war dynamics. And India could be one of the beneficiaries in that sense. So obviously, the size of the US market is so overwhelmingly big relative to the size of any other market that no single country or region can absorb those outflows from the US. And it's going to be spread out across many markets, but emerging markets will definitely benefit, in particular as the dollar continue weakening, and India could be one of the main beneficiaries. Absolutely, that's something that we will continue seeing.
Okay. Well, let me get Rahul into the conversation. Rahul, the CNBC-TV18 poll indicated that a 25 bips rate cut on June 6th is a given. There was only one person asking for a 50 bips rate cut. Otherwise, all respondents at 25. What's your sense of the terminal repo rate? Does it go to 5.5%, 5.25%, 5%? And also, what's your sense of the 10-year yield? Does it go below 6 this year?
Yeah, thanks, Lata. So, at this point, we are still comfortable maintaining 550 as the terminal rate for India, looking largely at the growth numbers. We are seeing some signs of stabilization on the growth side. It's not looking particularly exciting in the very near term, but, I think what we are likely to expect is that, profitability probably improves at the margin. We see a little bit of stabilization in high-frequency numbers already visible to a certain extent, and that probably lays the ground for the RBI to preserve some ammunition if and when growth slows down. I think there could be a case made for a lower terminal, but at this point in time, I think a lot of good news is already in the price as far as inflation is concerned, and so RBI probably will continue the easing cycle. We also expect a 25 basis point rate cut, but beyond 550, we think there might be a preference to kind of save some ammo in case it is needed to be deployed later on. On the bond side, again, we have had a very secular bond rally in India. We have seen the 10-year bonds come off by almost 75 basis points in the last 6 months. Our sense is that there's a little bit more juice left. We might flirt with 6% or below. But if there is a terminal rate of 550, then bond yields probably settle around 6%, give or take 10 basis points. But we will probably not see any further compression from there on. It also partly depends on how much capital flows and liquidity injections the RBI is willing to do further on. So we expect liquidity conditions to remain pretty flush. But then incrementally, again, it'll be a function of transmission is where we think the emphasis might come from Governor Malhotra in his Friday press conference.
Yes, of course, we'll watch out for that one. Claudio, what's your sense about the dollar rupee?
I think the currency will probably continue weakening. The dollar will continue weakening. I'm not necessarily on the camp of those that think that this is the beginning of the end of the dollar as the reserve currency of the world. I think that you will have to differentiate cyclical movements in the dollar from more structural ones. As I mentioned before this uncertainty and trade shock hit markets, global positions were massively overweight the U.S. under the idea that the U.S. was going to continue outperforming, running at potential or even above potential, and the dollar was going to remain the strongest currency in the world. What we are seeing now is part of that rebalancing. Obviously, the dollar needs to weaken. But when you think about the fiscal stance of many countries, as I mentioned before, not only the US, also Japan, Europe, a few emerging economies, UK, it's far from obvious that the dollar needs to weaken substantially versus other fiat currencies. I would.
So what's your range, therefore?
The dollar and other fiat currencies should weaken versus gold.
So what, would the dollar index go to 90, 95? What? What's the direction and what's the extent? A ballpark.
The direction is of a weaker dollar. Maybe the dollar should weaken across the board another 5-7%. But again, it's going to remain extremely volatile because it's very dependent on the evolution of trade negotiations and the outcome of fiscal policy in the US.
So your sense is that gold's rally isn't over. This year, what do you expect? 3,500, 4,000?
Yeah, the gold will continue strengthening, and this is more a structural story. If you take a look at the evolution of global money supply over the last 20 years and the evolution of gold prices, you can see what's going on. You can see that fiat money, even the dollar, is weakening relative to gold. and that might continue. Obviously, it's not going to be a straight line. It's going to be bumpy, but the direction of travel, I think, is clear.
Okay. Rahul, what's your sense? I mean, a couple of questions, actually, and not entirely related. Where do you see Indian growth this year after the higher than expected, but still modest 6.5% last year? And what's your sense of the dollar rupee?
Yeah, so on the growth cycle, we expect, broadly there to be a stability at, the lower levels of growth. I think it's important to keep in mind that, India's growth did slow down from averaging around 9% in the last 3 years to about 6.5% in the previous fiscal. This, we think, probably dips a little bit below to 6.3%, which is at the lower end of what the Ministry of Finance is forecasting, 6.3 to 6.8. And largely the downside comes from lower investment growth as uncertainty of trade policies, uncertainty of domestic fiscal spending, I think, does have an impact to a certain extent.
Yes.
But then monetary policy easing and then commodity prices will help. On the currency, we think, there's room for greater stability in the sense that we are likely to trade in a range, but that range is going to be a lot wider than what we have seen in the previous years. Governor Malhotra clearly has a policy of, being relatively more laissez-faire on FX, and, we think that 84 to 87 is a good range in which INR can move around. And then if we see capital flows make a big comeback later this year, then there could be scope for further appreciation in line with the weaker dollar.
Okay. Unfortunately, out of time, but thank you very much, Rahul and Claudio, for joining me in this conversation. And have a great conference out there. Whatever is left of it, I think you'll are wrapping up. Thank you very much for joining us. Well, we have to wrap up as well. On Bazaar, Chartbusters coming up.